Hey everyone, welcome back to our channel. Today, we're diving into a crucial topic for anyone who wants to invest with confidence. Understanding your risk tolerance. Whether you're just starting out or you're already investing, knowing how much risk you can handle is key to building a portfolio that lets you sleep easy at night. Let's break it down step by step. Segment 1. What is risk tolerance? Risk tolerance is a fundamental concept in investing, yet it's often misunderstood or overlooked. Essentially, it's your ability and willingness to endure the ups and downs of the market without losing your cool. It's not just about how much risk you think you can handle, but also about how you'll actually react when the market takes a turn for the worse. Imagine you've invested in the stock market, and suddenly, there's a significant drop. Your portfolio value declines by 20%. How you feel? Are you calm and confident that the market will recover? Or are you anxious and tempted to sell everything to avoid further losses? Your response to this scenario is a reflection of your risk tolerance. Segment 2. Factors that influence risk tolerance. Several factors influence your risk tolerance. Understanding these can help you better assess your comfort with different levels of investment risk. Let's break them down one by one. Age. One of the most significant factors is your age. Generally speaking, younger investors can afford to take more risks. Why? Because they have more time to recover from any potential losses. For example, if you're in your 20s or 30s and the market takes a downturn, you have decades ahead to rebuild your portfolio. Financial goals. Your specific financial goals also play a crucial role in determining your risk tolerance. Are you saving for a down payment on a house in the next few years? Or are you investing for retirement several decades down the road? The shorter your investment horizon, the less risk you might be willing to take on because you'll need access to your money sooner. Investment horizon. Closely tied to your financial goals is your investment horizon, or the length of time you plan to hold your investments. If your horizon is long, say 20, 30, or even 40 years, you can afford to take on more risk because you can weather the ups and downs of the market. Personality. Finally, your personality and emotional makeup are significant determinants of your risk tolerance. Some people naturally have a higher tolerance for risk. They're comfortable with uncertainty and even find it exciting. Others are more conservative by nature and prefer stability and predictability. Ultimately, these factors work together to shape your risk tolerance. Understanding them can help you build a portfolio that not only meets your financial goals, but also matches your emotional comfort level. It's about finding the right balance so you can invest with confidence and peace of mind. Segment 3. Assessing your risk tolerance. Now that we've covered what influences risk tolerance, let's talk about how you can assess your own. There are several tools and questionnaires available that can help you figure out where you stand on the risk tolerance spectrum. These assessments typically ask questions designed to gauge your reactions to various market scenarios. For example, you might be asked how you would react if your investment portfolio lost 10% in a month. Would you sell your investments to prevent further losses, hold on to them and wait for a recovery, or buy more to take advantage of the lower prices? Your answers to these types of questions help paint a picture of your risk tolerance. They take into account not just your financial situation, but also your psychological comfort with risk. The results will categorize you into one of several risk tolerance levels: conservative, moderate, or aggressive. Remember, these assessments are a starting point. They give you a framework, but it's essential to consider your personal experiences and how you've reacted to market changes in the past. If you've never invested before, start small and see how you feel as your investments grow and fluctuate. Segment 4. Matching your investments to your risk tolerance. Once you've assessed your risk tolerance, the next crucial step is to match your investments to it. This alignment is key to creating a portfolio that not only meets your financial goals, but also keeps you comfortable during market fluctuations. For those with a conservative risk tolerance, investments like government bonds, high-quality corporate bonds, and dividend-paying stocks might be more appropriate. These options tend to be more stable, offering lower but more predictable returns. The focus here is on capital preservation and steady income, making it a good fit for those who prioritize safety over growth. If you're more moderate in your risk tolerance, a balanced portfolio that includes a mix of stocks and bonds might be the way to go. This approach offers a blend of growth potential and income, with a level of risk that's somewhere in the middle. The idea is to capture some of the upside of the stock market, while cushioning against volatility with the stability of bonds. On the other hand, if you have an aggressive risk tolerance, you You might be inclined to invest more heavily in stocks, real estate, or even speculative assets like cryptocurrencies. These investments come with higher potential rewards, but also greater risk. It's essential to be comfortable with the possibility of significant short-term losses in exchange for the chance of higher long-term gains. Segment 5. Adjusting your portfolio over time. Risk tolerance isn't static. It evolves as your life circumstances change. As you move through different stages of life, your financial goals, responsibilities, and time horizons will shift, and your portfolio should adapt accordingly. For instance, in your 20s and 30s, you might be more aggressive with your investments, focusing on growth as you have plenty of time to recover from any market downturns. However, as you get closer to retirement, your focus may shift to preserving the wealth you've built, leading you to adjust your portfolio towards more conservative investments. Segment 6. Common mistakes and how to avoid them. Even with a solid understanding of your risk tolerance, it's easy to fall into common traps that can derail your investment strategy. Let's talk about a few of these mistakes and how to avoid them. Ignoring risk tolerance. One of the biggest mistakes investors make is ignoring their risk tolerance and investing in assets that are too risky. This often happens when people chase high returns without considering whether they're comfortable with the volatility that comes with those investments. The problem with this approach is that when the market inevitably takes a dip, you might panic and sell, locking in losses that could have been avoided if you had stuck to a more conservative strategy. Overreacting to market changes. Another common mistake is overreacting to market fluctuations. It's natural to feel anxious when you see your portfolio value drop, but making impulsive decisions based on short-term market movements can be detrimental. For example, selling during a downturn might prevent you from benefiting from the eventual recovery. Not diversifying. Failing to diversify your portfolio is another significant risk. Putting all your money into one type of investment, like a single stock or sector, can lead to significant losses if that investment underperforms. Diversification helps spread risk across different asset classes and sectors, which can protect your portfolio from large swings in any one investment. Segment 7. The role of a financial advisor. If you're feeling overwhelmed by the process of assessing your risk tolerance and aligning your investments, don't worry. You don't have to do it alone. A financial advisor can be an invaluable resource in this process. Financial advisors can help you assess your risk tolerance using their expertise and tools, and they can provide personalized advice based on your financial goals, time horizon, and life circumstances. They can also help you build and manage a diversified portfolio that matches your risk tolerance, making adjustments as needed over time. Working with a financial advisor doesn't just help you make better investment decisions, it also gives you peace of mind. Knowing that your investments are aligned with your risk tolerance and financial goals can reduce stress and help you stay focused on the bigger picture. Segment 8. Take action. Start aligning your investments with your risk tolerance. Now that you have a solid understanding of risk tolerance and how it impacts your investment strategy, it's time to take action. Start by reviewing your current portfolio. Does it reflect your risk tolerance and financial goals? If not, consider making adjustments. If you're new to investing, take small steps. Start with a diversified portfolio that matches your assessed risk tolerance, and gradually build up as you gain more confidence and experience. If you're already investing, regular reviews are key to ensuring your portfolio remains aligned with your changing circumstances and goals. Remember, investing is a marathon, not a sprint. The goal is to find a pace that works for you, one that allows you to grow your wealth while still feeling comfortable with the risks you're taking. With the right strategy in place, you can invest with confidence and stay on. Thanks for watching. If you found this video helpful, be sure to like, subscribe, and hit the notification bell so you never miss out on our latest financial tips and strategies. And if you have any questions or topics you'd like us to cover, drop them in the comments below. Until next time, invest wisely.